Drop it.
Hello and welcome to Be Real, the Maryland real estate podcast. I'm Brad Cox with the Vesta Group of Long and Foster, and across from me is the sparkling...
I'm not wearing any glitter. I didn't go to a strip club. What do you mean sparkling? Those days are long past. Brad, I am, if you didn't know already, folks, Michael Becker of Sierra Pacific Mortgage. It's a pleasure to be with you, Brad.
Right back
Sparkly
at you.
or not.
Yes. Well, it's your effervescent personality. I think that's the issue.
I am in a good mood today because today is Friday. We often record these on Saturdays, but you have something to do, so we decided to get together.
Driving to Chicago tomorrow.
Be safe.
I will. It's a great trip. I get to go see my daughter, so I'm happy.
That's always fun.
Yeah.
And it'd be even cooler if you had somebody to meet along the way. Because that is, are you going to do it nonstop?
I am. Well, I mean, might
Stop
have to
and get
pull off
something
the
to eat.
gas, whatever. But yeah, as much as I possibly can.
You have to get out and stretch your legs.
I'm loaded up with these chomp beef sticks. I love them. They're like grass-fed beef sticks, much better than, and then those and a couple of bars and things, and I just go.
I guess that's keto and carnivore diet approved, huh?
Yeah, I would say it is, sure,
Okay,
yeah.
I would think so, too.
But anyway, Michael, do you know what our episode number is?
11.
We're turned up to 11.
11. We turned up to 11. People, do you get that
goes up
reference?
to
You have to be
11.
our age to get that reference from Christopher Guest.
Yes, yeah. This is Spinal Tap.
Right? Spinal Tap.
Yeah.
Was that Rob Reiner's first film? It may have been.
Maybe. Yeah.
It's like 79, 80, something like that.
Late
70s, early 80s.
Yeah,
for
long
sure.
time ago.
It's hilarious.
Yeah. Yep.
Have to be our age. The youngsters who are listening to this, go watch it. You'll laugh. My
my
kids
gosh.
I share lots of movies from the 80s with them, and they always tend to love them.
You know, our mutual clients who I saw last night, I gave them an assignment.
Oh, no.
Yeah. What movie do you think I told them they need to watch?
I have no idea. Which
Michael.
one?
Any movie in the world that I would pick.
Arthur?
Arthur.
The most quotable movie ever.
The
according to
best and most quotable.
Bradford Cox.
That's right. Right. 4 out of 5 dentists surveyed.
Say it.
Love it.
I just giggle when I hear Dudley's giggle. Yeah. Right?
Yeah. Yes. Yes. There's so many. The scene where he puts the glass of bourbon on the side of his car and doesn't want to let it fall off. I mean,
stumbling.
it's just
He's
but
trying to balance himself.
there's so many great and Hobson's lines.
I hear you.
Oh my gosh.
That's
the
another
best.
good one, folks. If you're young and you're listening to this, go watch Arthur. You'll laugh. And not the Russell Brand one.
No, not the Russell Brand one.
I like Russell Brand.
There's
He's
nothing
funny.
wrong with Russell Brand.
But that movie's not.
But-
like most remakes, they suck.
The original
Absolutely.
Arthur. Yes.
Absolutely. In fact, that would be a good thing to come back and talk about at the beginning of next week's show. Is there, or has there ever been, a remake that's greater
That was better than the
the
first.
original?
That's a
Probably
great-
not, but there might be one or two out
Maybe.
there.
Maybe.
Well, maybe we'll research that and talk about it next week.
Yeah, maybe.
All right. So, what's this week's topic?
So this week we're talking about home buyer assistance, low down payment loans, and more.
We talked about first-time home buyers in previous one and a misconception about a 20% down payment.
Yep.
It's not needed.
Absolutely.
So we wanted to kind of go over all the programs out there that are available to buyers with low down payments, and then also followed up with some local, with being the Maryland Real Estate Podcast.
That's right.
We're going
And
to go
real estate being hyper local.
down payment assistance programs that are available to buyers out there as well.
Great.
We'll talk about pros and cons of each program. So hopefully it'll get people encouraged to look at things and ask some questions, and we'll always be there to help. You know, Brad, I was also thinking in the past, we always give our numbers out at the end.
Yeah.
Podcast is kind of long.
That's true.
People may not get to the end. Why don't we give a little phone number in the beginning and at the end?
What a great idea.
All right.
So, Michael
Becker, Sierra Pacific Mortgage. If you have questions about any things we're going to talk about in this program, don't hesitate to reach out to me. You can reach me on my phone. You can text or call 443-310-0012. And if you want to shoot me an email, it's my name at sierrapacificmortgage.com, or you can just do the short, michael.becker@spmc.com.
Great. And to reach me, cell is 410 888-375-7550. And my email is brad@homesbyvesta.com. That's a great idea. Good idea to bring it up.
Well, when we did the radio show,
Yeah.
we used to be on Celestial Radio. Is that what they call it?
Yeah, maybe. Yeah.
Instead of paid radio, I would give it out at the beginning of every break when we come back from every break, just in case somebody was listening, because you never know. When I did the radio show, most people who were listening were driving in their car, and they might only be in their car for 20 minutes out of the hour program.
And then they missed your number.
If they didn't hear the number, if I didn't repeat it enough, they might not get it. So always great to hear from anybody who's listened to podcasts in the past. All right, so what are we doing now?
A rundown.
And
Yeah.
we're going to talk about mortgage rates.
Yeah.
And mortgage applications, that data. Every week I give the latest data from the Mortgage Bankers Association. It tends to be it's from the week prior, but this Wednesday the Mortgage Bankers Association came out with their application data, and overall mortgage applications increased 3% from 1 week earlier.
That's great.
That's the third straight week of increases. See, and these are seasonally adjusted, so it's kind of telling us that the spring buying season has already sprung.
Yep.
And it's getting busier.
Yeah.
Part of that, the encouraging part was the first week that it increased, rates hadn't improved, but that's a little different now. The composite index increased 3% week over week. The refinance index was up 5% week over week, and the purchase index was up 2%. I speculated last week the reason refinances may have gone up is back in October, we had the 10-year Treasury hit like 4.3%. We had 7.375,
right?
Almost 7.5% on 30-year fixed rates.
Yeah.
Those people, 6 months later, may be looking at refinancing now, believe it or not.
Well,
that I think maybe a few of those might be, especially the people with FHA loans, because the MI cut that we've talked about in previous shows,
yeah,
a drop of 0.75% in interest rate, and then
can
another
really impact the monthly payment.
right, another 30 basis points on the mortgage insurance might mean it makes sense for them to do an FHA streamline. So I suspect I wouldn't be surprised to see the refinances increasing as long as rates stay where they are if they continue improving. Speaking of rates, they did continue to improve. According to the Mortgage Bankers Association, the 30-year fixed rate dropped to 6.48%, the lowest level in a month.
Nice.
Again, this is data from March 17th. We're recording this on March 24th, and that improvement in rates has continued. You and I like to talk about Mortgage News Daily because they change the rate every day. And it tends to give you an average rate with low points. The Mortgage Bankers Association tends to have 0.6 or 0.7 points or 0.8 points rates. Mortgage News Daily is usually very low points, and but it is for the best borrowers in the best situations.
Right.
But their current rate right now is, what did you say,
6.38.
That's 6 3/8.
Yeah.
So, and that is a conventional loan. Govy loans, FHA and VA loans, many of them are in the 5s at this point for well-qualified borrowers. So we've seen a nice improvement. Now the question is, what's happening?
Right.
And I usually talk about my vote, what I think the future week is going to have.
Yeah.
It's not often I do this.
No, I think you had some great points to make. You should read it verbatim.
I'm going to read the vote I sent into Bankrate for my forecast for rates in the coming week. At the end of the current FOMC meeting, the Fed announcement had some changes in it that have bonds rallying and mortgage rates dropping. They mentioned the U.S. banking system, which makes sense given the recent bank failures. They said that recent developments are likely to result in tighter credit conditions for households and businesses. The implication is that tighter lending conditions will help the Fed in its fight against inflation, and it may allow them to pause sooner rather than later. They also changed the wording from ongoing increases in the target rate to some additional policy firming may, not will, may be appropriate. I think bond markets they're going to start pricing in rate cuts sooner than before this statement, and this will lead to lower mortgage rates in the coming week. That was my vote.
It's great news.
Well, a little banking stress out there.
Yeah.
It does make sense. Banks, when things get tough for them, they may tighten up their lending.
Well, the smaller regional banks especially,
Yep, and they are a big part of funding businesses and consumers. We're not just talking mortgages here.
No, but any kind of commercial
Thankfully,
lending.
I don't think we've seen any
new
tightening.
Construction lending.
Right. We haven't seen any tightening of conditions when it comes to mortgage lending because they're controlled by Fannie and Freddie, and Fannie and Freddie are in the conservatorship of the federal government,
Right.
and then government loans, USDA, VA, and FHA loans, we're all going to talk about today, are also government. They're explicitly government backed.
Right.
So I don't, unless something really bad happens with them, we see increases in defaults or foreclosures, and they're actually dropping. If you look at the latest data from BlackRock, or not BlackRock, we don't like BlackRock, Black Knight.
That's right.
We've seen foreclosure data. It's not going to be 2008.
No, it's a very different number.
People have much more equity.
Much more equity.
They're in very good.
We learned a little bit more of a lesson from 2008.
They're all in good loans that were mostly fixed rate, not adjusting to much higher payments, things like that.
Or no interest at all.
So I do think time will tell. If banks pull back their lending a little bit, that will slow the economy a little bit, which will help inflation, which means the Fed
helps do the job that the Fed's trying to do with the interest rate.
I've heard commentators out there saying that restrictive bank lending might equate itself to a 0.5 point to 3/4 points in rate hikes that the Fed was talking about doing. So,
well, that could be encouraging.
We will see. We do have the consumer price index coming out next week, and I think what will happen is the headline number will improve greatly. We've seen food, and specifically energy, gasoline's been pretty.
It's been,
and the price of oil has
good.
dropped pretty drastically.
Yep.
But services is kind of sticky. That's the part that the Fed's concerned about. But I think we'll see continued improvement, and we also have some very big months where the monthly increase last year, or I'm talking about March, April, and June last year, had big month-over-month increases. They will drop off in the annual number, and that may help the annual inflation number come down. So time will tell. We never like volatility in interest rates.
Or anything.
So a slight improvement.
We might talk about that a little bit in...
Well, that was what it's called, a foreshadowing.
Yeah, it's great.
You like that?
Volatility, thank you.
We are going to talk a little bit about volatility, but nobody likes it. Don't like it when rates go up super fast, and rates dropping quickly kind of disrupts markets as well.
Yeah.
And the up and down will drive anybody who's trying to make plans crazy.
Yeah.
But a slow decrease in mortgage rates is something that would be welcomed.
Sure.
Given the higher values of homes, it would make it more affordable to those buyers.
Help ease affordability, yeah.
All right. Speaking of buyers, you got some data on local sales.
We do, yes. In the Baltimore metro area, we're going to the last 7 days. So let's talk about a number of different things. The active listings, we saw 3.46% increase in the active listings from last week. 318 last week, 329 this week. We saw the pending sales dropped a little bit, about 3%, 2.91% from 757 last week to 735 this week. Settled properties, though, increased 7.86%.
That's a good number.
Yeah. So we had a decent amount of sales. 420 last week, 453 this week. And those homes that went off the market, this one was, I have to do a little bit more digging on this to try to find out exactly what happened, but that jumped up about 16.67%. Last week we had 216. This week we had 252. Now that the off markets can be withdrawn, canceled, expired, or even just temporarily off, when people take a home off the market for a short period of time for repairs or some other short-term reason. So I'll do a little more digging and see if I can figure out what's going on there.
Okay.
Yeah. Average days on the market ticked up just a hair, 3.83%. Went from 36.83 to 38.24.
That's not significantly.
That's not. No. No.
Statistically significant.
Yes. Right. Total volume was up 10.17%. Goes along with the number of settled properties going up. So volume went up, though, as did the number of settled properties. Went from 164 million up to 181 million. Number of concessions, you would think, also increased, and it did a little bit, 2.42% up from 165 to 169. But the percentage of the deals getting concessions dropped a little.
Really?
So yeah, a little bit. Not significantly, but about 5%.
And these are all closed deals, right?
These are closed deals.
So it's interesting when you think about it. There's folks when I give you data, it's about applications which haven't closed yet, and they can increase.
It's a leading indicator. I'm giving you the trailing indicators.
And the point I'm trying to make is at the beginning of February, February 2nd being the recent low in mortgage rates.
Yeah.
A lot of these closings that we're talking about were based on those lower rates.
Yeah.
So,
right. It's a good point.
So,
Good point.
So maybe when rates were low, people didn't need
as much help.
Exactly.
Yeah.
That's the point.
It's a good point. All right. So the average concession went up a little bit, however, 3.41%. So from 72.85 up to 75.33. The average list to sold price ratio, very flat. Very flat. With auctions, 104.29. It was a 0.06% increase, decrease. And then if you exclude auctions, we went from 98.55 to 98.13, so still 98%, really close to the list price. So that was great. Now here's one that was a little surprising, given the fact that we saw last time we reported there was a 1.5% drop in the median sold price. And I said that that's not really indicative of a trend. I would still expect to see things increasing. But over the last 7 days, we saw a 5.44% decrease in the median sold sales price. Now, again, it's 2 weeks. It's not really a trend.
Not a trend.
It's not a trend. So we're going to watch it, but it went from 344,750 to 326.
It could just be the specific houses.
That's right. At housing stock that sold during that period of time. So we'll watch it, see what happens. When we get to the monthly, the month over month will tell us something meaningful.
Right.
So, but anyway, and there were about 20 auctions last week, so fairly decent number of auctions. So when we strip that number out, that's why it changes so much. Okay. So Michael.
Yes, sir.
Message for buyers and sellers. Buyers, we're going to get back into competitive market again for those prices, for those homes that are priced well and are well updated. We're going to see multiple offers where interest rates are starting to come back down. Buyer demand is going to creep back up. You're going to start to see more people bidding on each individual home. So be prepared for that. Sellers, you're going to benefit from that change.
No, but think about selling your house.
Yes, but yeah, absolutely.
I had a client that was $1 million price point who asked me about, they thought about downsizing, and they're real happy with the rate they had, but they were in $1 million home in Montgomery County.
Yeah.
And I remember last year thinking, if rates really start going up, they should probably sell. And I said, if this is what you want to do, I think you need to list your house yesterday. Turns out I was probably wrong about that. Given the lack of inventory out there, they may not be looking. I was thinking that at that price point, they may be looking at a drop in
value because it was going to sit for a while.
Or
right.
It might be harder, but I might be wrong about that. Now that is a higher price point, and I could have been correct, but it might be worth revisiting that if they do want to downsize.
Yeah, absolutely. Well, I think it's very dependent on the specific area, what's going on in that particular neighborhood even. So
yeah, it's like when I use Zillow a lot. I don't have access to the multiple list system, but you can pull up a map and see all the sales in it, and there's certain areas that have, like, you put in a zip code, there could be 6-7 homes in a price point from $300,000 to $500,000 in a zip code.
Sure,
that's like nothing.
Yeah, right.
You go to another zip code, and there'd be dozens of homes.
Yeah,
so
absolutely.
Right, to your point.
So yeah, and it's going to depend on a lot of things. That's why when we give you these metro-wide numbers, your individual county, your individual zip code, your individual neighborhood may differ from what's going on here, which is why it's a great idea to talk to a professional and get a really clear picture of what's happening right where you live.
I agree 100%. People like Brad and myself tend to follow those trends, are up to date on all the data, and can give you solid advice.
Yeah, absolutely. All right. Well, Michael.
Yes, sir.
That wraps up the rundown.
When we come back.
When we come back, we're getting into the scoop, and that's when we get into the homebuyer assistance, low down payment loans, and more.
Sounds great.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, joined by the ebullient.
God.
I'm going to give you a different adjective every time.
I'm going to have to Wish I had my watch on and I could ask Siri what that means. And I have a pretty good vocabulary. I will be Googling it. The meaning of that. Thank you, Bradford.
You're assuming.
I'm assuming that it's a positive,
It is a positive,
adjective.
yes.
It sounded ebullient.
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 Yeah.
There was like an extra syllable in there.
Yeah.
Anyway, I am Michael Becker. Whether or not I'm ebullient or not is left to be determined. However, I do work for Sierra Pacific Mortgage, and we're here to talk about different types of mortgages and who are these mortgages for and how will they help, Brad?
Yeah, and some of the pros and cons and dispelling some myths. Michael, it's a great topic.
That wasn't a statement. That was a question, my friend.
Oh, who are they helping? They're helping people, first-time home buyers, people with lower income. These are all people who
struggle to save for a down payment.
Yep.
Low down payment loans.
Yep.
Many are for, mostly this is geared to, we want to kind of talk about first-time home buyers, but they are eligible. These programs are eligible. Well, we'll delineate whether they are eligible to first-time home buyers or not.
Sure.
Like a lot of the second half of the scoop, we're going to talk about down payment assistance loans, and mostly they are restricted to first-time home buyers.
Often, yeah.
So let's just jump in there. And I thought a good way to organize it, Brad, would be to go from the smallest down payment to the largest small down payment. Does that make sense?
Which is still not that large.
Right, we're
relatively small.
We're talking 0 to
3.5%.
3.5%. That's all we're talking about. Right?
Yeah, that's great.
So as far as I know, well, unless
you can't get below 0.
Well, ask Europe about their bond yields. No, that's a topic during the post last decade or so. Anyway, yes, you can go negative, but you're not going to get a negative down payment. However, not to get off topic, but there was, for a brief moment in time, in the last decade, a country, I think it was Denmark or the Netherlands, that had a negative interest rate on a mortgage. It was a 5-year adjustable rate mortgage.
Wow.
Which meant you paid less back less than you borrowed.
Wow.
How insane is that?
That would be would be nice.
You wonder why we're in the dilemma we're in now with higher inflation and rates having to go up so fast so quickly.
Sure.
Folks, that's a topic for another day. We're here to talk about loan programs with low down payments
here in the U.S.
In the U.S., right? We're not licensed in
Denmark,
in Amsterdam,
right?
Well, Denmark's not in Amsterdam; that's the Netherlands.
Yeah,
or Holland. We could go on. Now I'm going on another Jerry Seinfeld tangent. People
forget the tangents. Mortgage
focus, Michael. Okay. All right, we're talking about zero and low down payment loans for any buyers, but more specifically for first-time home buyers. Because a lot of times, if you're selling a home, an existing home, and buying the next home, you generally have a down payment from the equity you've built up in that first home. So let's focus on those first-time home buyers. All right,
that's great.
Start at 0%. Mm-hmm. There are a couple programs out there.
Some of the best loan programs around.
Available. And like all programs, they have pros and cons.
Yeah.
So let's start with the USDA.
Yeah.
United States
Department of Agriculture.
Thank you. I was throwing a blank there.
I'm here for you.
Has rural loans.
Yeah.
Right?
Sure.
But what is rural? That's a good question. Let's start.
Not
every area qualifies for USDA loan.
Right. In our Baltimore metro area, there's only certain parts of that would qualify for the USDA loan. So it is geographically oriented to the more rural parts of those counties.
Correct.
So
USDA has
northern Baltimore County, Carroll County,
almost
northern Harford County.
All of Carroll County outside of Westminster is pretty much USDA.
Sure.
Loans.
Lots of cows.
Good way to think about it is you have 95, from I guess the Susquehanna River down to D.C. On either side of that. Most of that area is not. The populated areas, most of that is not USDA eligible.
Right. Thankfully,
the USDA has an eligibility map. You can put in any address.
Super easy to find out.
Right. For example, I mentioned to you during the break, were you aware that there are some places in Reisterstown, Maryland, that are USDA eligible?
I hadn't expected that.
And it's just a few properties to the west of 795 off of Cockeys Mill Road in that area before you get into Carroll County.
Yeah.
Like we said, most of Carroll County is USDA eligible. But the point being, I think there are more homes eligible for USDA financing than people think about. And this is often a forgotten program out there, and it may be one of the best programs.
Sure.
It's a government-backed loan.
Yes.
And that, for interest rates, that generally means what? Government-backed loans tend to have slightly lower interest rates than conventional loans at Fannie and Freddie because of the the
guarantee from the Fed.
From the federal government, exactly right. And USDA loans also benefit in that it's not a mortgage insurance premium. They call it a guarantee fee. Now, they have a guarantee fee that's an upfront portion to it and a monthly portion. And in recent years, these both have gone down.
Yeah.
The upfront portion is 1%. It's rolled into the loan. It's not something you have to come up with, but it does get rolled into the loan amount. And the monthly amount is a factor of 0.35. That's very low. The FHA is currently at 0.55%, which was recently dropped from 0.85%. So the combination of the lower interest rates we get with government loans, the lower monthly guarantee fee can often mean a much lower monthly payment.
Yeah.
Again, the house has to be in a rural area to qualify. Those are the positives with USDA. The negative is that not only outside of geographic restrictions, not everyone.
There are some other restrictions involved.
Right. Not everyone will qualify.
Sure. Right.
Number one
some
being
income restrictions.
There are income restrictions. That was my number 2 thing.
Okay, I'm going out of order. All right, how about DTI?
That's the number one. That's what's going to restrict most people because they're much more restrictive than conventional FHA or VA loans.
Yeah.
If you look at the guidelines, they talk about a 29% front-end ratio and a 41% back-end ratio. That needs explaining. 29% ratio, the front end, is your housing ratio.
Right.
It's the principal and interest portion of your mortgage, the taxes, property taxes, your homeowners association fee, any homeowners association fees associated with it. Anything that goes into what it costs you per month to pay for the house is your front end ratio. Your back end ratio is the housing payment plus your other debts showing up on your credit report, the minimum monthly payments, not what you pay. People often forget that.
Right.
It's your monthly car payment, if you carry any kind of credit card debt, and even if people who pay off their credit cards every month often will show up on the credit report a $500 or $1,000 balance they pay off.
Right.
It comes with a minimum monthly payment.
Right.
So whatever those minimum monthly payments and your housing payment add up to be, you want to be below 41%. You mentioned income guidelines.
Sure.
There's an eligibility website for USDA, and you can put in things. It asks specific questions. But in Baltimore County, for example, a 2-person income must be below $129,400. One thing to remember about USDA and the income eligibility limits, it's household income. Anybody who's living in the home, their income must be considered. Right. If you're buying a house and let's say you're older and you're buying a house and you have adult children or teenage children who have part-time jobs, if they're going to live in the house, everybody's living in the home's income must be considered. Just looking at income, truth be told, $129,400 is a pretty high income, and that'll qualify most people. For most first-time home buyers are probably below that. But remember, it is household income, not just qualifying income. Yeah. Because we're going to get to a program later that just looks at qualifying income, not necessarily housing income. Not to make it to make it complicated, but that's why they call it.
It's not like it's not complicated already.
I'm trying to explain. So USDA.
Well, it's great that we have people like you who know it, so that it doesn't have to become complicated for the rest of us.
But again, if you qualify for it, if you're looking in a rural area, and you want a small down payment, that'd be the first place I look. A, if the house is eligible. B, if you qualify income and debt-to-income ratio.
Yeah. Great.
There is another 0% down payment loan out there.
One of the best programs, I think, out there.
I think
in general to support a portion of our population.
And what is this loan?
The VA loan.
The VA loan.
The Veterans Administration.
So, in order to qualify for this loan, you must be a veteran or an active military person, or you can be a spouse.
Surviving spouse.
If you're a surviving spouse, you can also qualify for that.
Yeah. Although, I learned something fairly recently that I hadn't known before.
What's that?
Which was VA is one of the assumable loans out there.
Correct.
And you don't have to be a veteran to assume a VA loan.
I'm so glad you brought that up.
Yeah.
Because I have another tidbit that let you know about.
Oh, really?
In regards to that.
Okay.
You're 100% correct in that.
Yeah.
However, the veteran who allows you to assume it
Has to count it toward
his eligibility and his future ability to buy a home.
right.
Now, if he were, it may not matter because VA loans do allow, you can have more than one VA loan, but when you buy one house, you use up some of your eligibility, it probably requires the next VA loan to have some kind of down payment. It's a very complicated calculation.
Sure.
But it's something I have somebody who's looking now at a VA loan and they might want to turn that one into a rental and then buying, they're looking
Right.
down the road, turn it
Sure.
into a rental property and then buy another home. Their choices will be to refinance out of the VA and then have full eligibility, or keep that and then come up with a down payment down the road. So
Yeah.
a VA loan is assumable. It's a great, especially if you have a low rate, it'd be a great selling point
Yeah, absolutely.
on a house.
Absolutely.
But it would curtail they'd have less eligibility
Right.
moving forward. So, pros, 0% down.
Mm-hmm.
It's a government-backed loan, like we said with the USDA loan. Best interest rates out there are better than conventional rates tend to be.
Yep.
Best feature of it is there any kind of monthly mortgage insurance with a VA loan?
There is none.
None.
Yeah.
Absolutely. But there is a thing with VA loans that's called a funding fee.
Right.
And when you buy the home, that there's a funding fee. Now, it's nothing that you have to come up with to put down on the house, but it gets wrapped up into the loan.
Right.
Now-
Just like with USDA, and it's not called the funding fee, but the same thing, right?
Correct.
They can.
And the amount of the funding fee is dependent upon whether it's the first time use of your eligibility or subsequent use, anything after the first use, and the percentage of your down payment. First time use and borrowing 100%, putting 0% down is 2.3%.
Mm-hmm.
It's 3.3% if it's your second use and you're putting 0% down. On subsequent use, a 5% down for both cases is 1.65%, and a 10% down payment requires a 1.4% funding fee.
Okay.
That gets rolled into the loan. So it basically adds to your loan to value. So when you close, if you did 100% financing on a VA loan, post-closing, you could be looking the day after closing at over 102% loan to value. So
Okay.
it'll take some time to pay that loan down and to get some equity in the house.
Right.
If you're looking to sell, it's just something to be aware of.
Right.
Now, there are people out there who have that funding fee waived for them. Anybody who is disabled, you must be. Now, when it comes to the VA, on your certificate of eligibility,
Yeah.
it'll say whether you're disabled and how disabled you are. They put it in percentages.
Right.
If you're at least 10% disabled, your funding fee will be waived. If you're a spouse of someone killed in active duty, your funding fee is also waived.
Yeah.
And if you're active duty and received the Purple Heart, you
Funding.
also have your funding fee waived.
Very nice.
So, and it's surprised. A lot of people have injuries where during their military service, where they get some kind of disability. It doesn't stop them from working their future jobs,
Right.
but they are considered disabled.
Sure.
And having that funding fee waived makes it a much, much more affordable. Now, as far as the only cons for the VA loan, because you said it's the best loan out there, the only thing I can think of is how restrictive it is. It's only eligible to the
To
veterans
the small portion of the population.
portion of the population. But one of the strengths of it, I know, is that there are no debt-to-income ratio caps.
Yeah.
I've actually gotten somebody done on a VA loan done with what's called with a back-end ratio, that total debt-to-income ratio done at 62%.
Wow.
And I've heard of people going higher. The VA loan looks at things differently than just a debt-to-income ratio aspect. They look at residual income. After you've paid all your debts, they ask for things like child care expenses and other things like that.
Yeah.
And then we'll calculate basically your disposable income after everything. And that's how it allows, if you've entered the data correctly, you can sometimes be surprised at getting a VA loan approved at a higher debt-to-income ratio. Now, having said that, I'm very cautious
Well, you need to be.
on doing something like that. The loan that I got approved at a 62% back-end ratio he was in a relationship with somebody who was not his spouse. He was really dying to refi this property into a VA loan to get the loan rate affordable. It was the only loan we could do because he had VA benefits to pay off his wife. But he had a significant other who was contributing to the bills but could not be on the loan because you can't have a girlfriend or a live-in
Right.
person be on your VA loan. It must be your spouse.
Must be a spouse.
Right. So that was the issue with that. But that is a strength of it. It does consider things, and you can go down to a 620 score. Well, I didn't mention that about USDA. We used to have 640 minimum credit scores, but we'll go down to a 620 credit score. So a fairly low credit score, and you can qualify. There are lenders out there, and I imagine I could broker them below a 620 with VA. But anybody who has below that kind of score, first step is trying to improve their credit score up to that, so they get a slightly better rate. But But you and I both know that it's not that hard to get your score up to a 620.
It's certainly achievable. You know what else made VA a little more attractive?
What's that?
Was the recent ruling by the VA about the wood-destroying insect issue.
What's that?
So the VA ruled, I believe it was a couple of months ago, that the buyer could now pay for the wood-destroying insect inspection and and any repairs. So it used to be on the seller, and so
sometimes sellers would be hesitant.
Sellers would be reluctant.
The inspection wasn't that big of a deal, was it?
The cost of the inspection wasn't the issue. It was more. It was more the fact that you had to see that report, and there were a whole bunch of requirements there, and so it did cost the seller a little bit more money, all things being equal, to take a VA loan over something else, and that is gone now. And because the contract is as is, there's some language about wood-destroying insects in the VA addendum, but the buyer can actually make the repairs on a VA loan now.
Yeah. So those are the 2 0% down payments. They're more restrictive than anything else, but you'd be surprised of the number of people who qualify for both VA, especially in this area. We tend to have a large military. We have a base in Aberdeen.
Sure.
We have Fort Meade. There's a lot of people.
Right.
Anybody who lives in those areas, one of the first things when they asked me, I said, "Are you ex-military?"
Sure, absolutely.
I want to make sure, because you'd hate to overlook that program. I can remember back in the day, the subprime days, people would avoid things and push other loans on them to the avoidance of a VA loan because they just didn't want to. It was easier to do a loan, and they were foregoing a great benefit to a
huge
buyer
benefit.
there.
Huge
So
benefit.
If you're a veteran, active military.
First of all, thank you, and secondly,
great point.
Make sure you take a look at the VA loan products.
All right, now we're going to switch, since we're going from smallest to slightly higher. I don't want to say high down payments because none of them are very high.
Right.
We're going in order.
Yes.
0, 0. Next step along the way.
3%.
3% down.
Yeah.
Fannie and Freddie.
Yep.
Have loan programs that allow 3% down. Let's talk first about income restrictions on them, and we're going to go from best to worst. So there's several different people who qualify for a 3% down payment with Fannie or Freddie.
Yep.
You don't have to be a first-time home buyer, but if you're a home buyer and your income is below 80% of the area median income, you qualify for either Home Ready, which is a Fannie Mae product, or Home Possible Freddie Mac product.
Yeah.
80% of the area median in the Baltimore area is $92,880. We saw a nice increase last July. I would not be surprised to see the same. Once a year it gets increased. I wouldn't be surprised given inflation, because we saw cost of living increases with Social Security of 8.7%.
Sure.
In January, so I wouldn't be surprised to see that up. So that number does change and it goes up, and I don't know that it just was inflation, but I guess if area median income if wages are going up, the area median income would go up.
You'd expect that to go up as well. Yeah,
exactly right. So if you're below 80%, you can put as little as 3% down,
and you get another benefit,
and that is lesser private. If you put 3% down, your mortgage insurance
and
premium,
you qualify for Home Ready or Home Possible.
Correct. You get a mortgage insurance premium that's less than if you didn't qualify.
Yeah.
But the lower the down payment, the higher the monthly mortgage insurance tends to be.
Right.
The higher credit scores are, the lower the mortgage insurance will be.
Right.
And guess what? If there's 2 borrowers instead of 1,
lower the risk.
Exactly. Someone to lose a job.
Still have one job left. Yeah.
So the mortgage insurance is a little lower.
Yeah.
With that.
Yeah.
Okay. So Home Ready, Home Possible, $92,800. Low rates. The best thing about that is, we forgot to talk about the rate portion of it. all loan level price adjustments get removed. We've talked about loan level price adjustments with Fannie and Freddie loans. Basically, there are none. So you can have a 680 score and get the same rate as somebody with a 780 score. You could be buying a condominium. There is traditionally a 3/4 point hit for condominiums. That goes away if you're home ready, home possible, eligible.
Yeah.
All those loan level price adjustments are removed. So what it means in terms of rate, if you were above that income level, your rate might be 3/8 to a half point higher, depending upon the situation. That just gives people a rough estimate.
Sure.
And you're getting lower mortgage insurance premiums. So it's also a very, very good thing.
Yeah, absolutely. Helps with affordability quite a bit.
One thing I wanted to say, I wanted to talk about income because I mentioned it. I was very specific on the USDA and talking about household income.
Yeah.
The interesting thing about income with Home Ready and Home Possible is it's only qualifying income.
So if it's one spouse.
So one of the things I first look at is there a way to qualify using just one spouse's income or even both spouses, but let's exclude bonus or commission income, something like that. If we can exclude that and you're below that level, you're going to qualify for that product. So it's only qualifying income. It's not household income. It's only the people going on the loan. So sometimes, as much as I would like a married couple to have both people on a mortgage,
but there may be times when it may be more beneficial.
I'll give it, and it'll be up to the reason you want them both on it is because you want to see the mortgage history. A, you want them both obligated by the mortgage should something happen.
Sure.
B, you also want to make sure it improves their credit over time. Having a mortgage adds to the credit profile that you have, and paying the mortgage on time will tend to increase your credit score.
Sure.
But if it means a significant difference in the monthly payment, then I wouldn't be doing my job if I didn't look at that.
Yeah, sure.
Okay. So when it comes to people above that, say there's nothing I can do to get you below it. Let's say one spouse makes $50,000, the other makes $95,000.
Yeah.
Oh, they're above it. There's nothing and the one who makes 50 or 60, I can't qualify them for
On
the house
her own.
they want.
Yeah.
So they're above it. So the next step is to see if they're below. If they are first-time home buyers, we can see if they are below 100% of the area median income. If they are, then they can also put 3% down, and they will also have those same no loan level price adjustments and get a much better rate than they would otherwise.
Nice.
Downside is the mortgage insurance premium is not going to be reduced. It's going to be the full one. But we're talking a few bucks here. I basically looked at it. Let's say on a $350,000 loan amount, if you both have high credit scores and you're above that,
Yep.
it might mean $20, $25 a month in the mortgage
So
insurance.
not a big
It's not a big
factor.
deal, but if I can save you that $25 a month, I'm going to try every single time.
Sure, absolutely.
Okay. If your income's above that level, let's say for some reason there's no way to get you below 100, and the area median income is 116,100. This is the Baltimore area, I must say, folks. Anybody who listens to this who's in D.C., it's a much higher level. It's 146 is the area median income.
Right.
So it can be a different story. But if you're above that, can you still put 3% down if you want it?
Well, it's a great question. I'm not sure.
You can, but at least one buyer, and this is with Fannie Mae,
Yeah.
with at least one buyer must be a first-time home buyer.
Oh,
so
okay.
sometimes there are times when one of the spouses owned a home prior, and their incomes are a certain level, but by adding your wife or husband to the loan, and they are first-time home buyers, you would qualify for a 3% down payment. Now, you're not going to get the no loan level price adjustments that others might get.
Right. But you can still do that lower down payment.
Correct.
Yeah.
And, Brad, as we know, the new loan level price adjustments through Fannie and Freddie, which we scratch our head about.
Yeah.
The best rates go to who? Those with 3% down.
Right, yeah.
It almost dissuades somebody from putting 5 or that's why you're getting
putting more money down.
5 or 10% down.
Right.
So you'll get a better rate with a 3% down payment if at least one.
It's counterintuitive, but
the idea behind it's hard, when you think, I agree, and the idea behind it is to provide loan products
to those who need it the most.
for first-time home buyers. So at least one buyer has to be a first. They want to help first-time home buyers.
Sure.
For the longest time, that's been a reduced portion of the buying population. Historically, first-time home buyers make up 40, 41, 42%.
Millennials are tearing it up.
And they are actually helping that. But I recent month, I looked at a recent month of data, and it was only 27%. So that I would like to see more first-time home buyers buy it. You know, given where interest rates are and home values are, it's tougher for first-time home buyers to get into the home owning.
It is.
Get into owning their own home. We have one more product, but it just occurred to me that I didn't talk about concessions. But what we'll do is we'll finish everything up.
Yeah, I like that idea. I was actually thinking about that. We could come back and hit those afterward.
Great.
Yeah, good.
And we were thinking alike. I think it makes more sense to do it.
Sure.
And the final one, we're going to go back from conventional loan, which is anytime somebody says conventional loan, folks, it means a non-government loan.
Right. Back to a Govy loan.
Government loan, right. Govy loan, as we say in the biz. An FHA loan.
Yeah.
Do you know what that stands for?
Federal Housing Administration.
So an FHA allows how much of a down payment is the smallest down payment you can make?
3.5%.
All right. Recently, they made a change. And what was that change, Brad?
They dropped the mortgage insurance premium.
Correct. You said that. And that stands for MIP.
Right.
Perfect, Brad, because everybody calls it PMI.
It's not PMI. It's MIP with the FHA loan. And they dropped their mortgage insurance premium by 30 basis points from 0.85 to 0.55. And if you had a higher down payment, down to, what was it? So
it goes to 80 basis points, but I pointed that chart up on our wall that nobody can see that I want you to look at, and it can show you the savings on different types of loans. So on a 350, let's say 350, that sounded like that was close to the median sales price, wasn't it?
Sure, about that, yeah.
All right, how much money do they save per month going from the 85 basis point MIP to the 55 basis point?
$86 a month.
That could be your BG&E bill.
Absolutely. Not mine, but most people's.
Yeah, right. If you have teenagers, you learn to leave everything on.
And every electronic device known to man. And people who don't know how to turn off lights.
Turn the thermostat up to 74 because in the dead of winter they have to wear T-shirts and tank tops.
Sure.
Tank tops and shorts and flip-flops like it's summertime. Right? Anyway, I'm just kidding. But it does help. That's a nice drop. So,
yeah.
FHA loan allows 3.5% down, and they have recently reduced their mortgage insurance premium. It's probably the most widely used program for those who don't have perfect credit.
Sure.
You get the same rate. We've talked about loan level price adjustments, and folks, what they mean is they're adjustments based on loan to value, credit scores, and things like that. The higher your loan to value tends to be, and the worse your credit score, the more you're going to pay in adjustments.
Right.
FHA doesn't have any of those.
Right.
Somebody with a low credit score gets the same rate as somebody with a high credit score. Essentially, there are some lenders that have built in a few pricing adjustments based on that. But it also has expanded underwriting guidelines, meaning that you can have a higher debt-to-income ratio and qualify. Conventional loans tend to cap out at 45%, and sometimes you can go to 50%, depending on the compensating factors. With FHA, you can often, depending on you have to run it through automated underwriting, you can go as high as a 57% back-end ratio.
Yeah.
So it is a great product. Now, I would say, of all things, you brought up mortgage insurance premium and the reduction of the monthly amount.
Right.
But with FHA, just like the USDA and its upfront 1% guarantee fee, there is a upfront mortgage insurance premium.
Right.
It's 1.75% of the loan amount.
Right.
Gets added into the loan.
Yeah.
So the drop, one thing I think is worth mentioning, anybody who has good credit, well, everybody's credit, one thing I have been looking at lately is the monthly payment. It's a government loan, so the interest rates are much lower. That's another benefit.
Sure. Yep.
Should definitely mention that. Expanded underwriting guidelines, higher debt-to-income ratios, very good rates. It's got a higher MIP. It's available everywhere, too, geographically speaking.
Right.
Anyhow,
Right. No limitations.
No limitations.
Yep.
Because of the drop in the mortgage insurance premium and the lower rates available as compared to conventional loans, sometimes you will find yourself having a lower monthly payment with an FHA loan than you are
with a conventional
loan with a 3% down payment.
Yeah.
It's worth exploring them. But we did mention the downside of the upfront mortgage insurance premium.
Mm-hmm.
Brad, if the payments were similar with those two products, or let's say FHA had a slightly lower, like I'm saying $20 to $40 a month, lower monthly payment than a conventional loan with a 3% down payment, would you consider, if as long as the borrower qualifies for both,
Sure.
should borrowers think about the upfront portion of the mortgage insurance premium?
I mean, it can get rolled into the loan.
Correct.
So it's really a minuscule piece of it, I think.
Well, all things being equal, they should think about. You're right. It shouldn't be overthought.
It's not the end of the world.
Correct. If lower payment is all you care about,
right,
then you go with lower payment.
And that can be, and honestly, that's what a lot of people are driven by, which is why I responded that way, right? You should think about it, but most people care, what's my monthly payment going to be?
Most people buy with a monthly payment.
Yeah.
Now, there are some that, and that's why I'm a number cruncher, and I let people know. You might say, all right, so if it's $40 a month, but I got to roll this 1.75 months, how long before, with this lower monthly payment, before I've covered that?
Right.
And if you were somebody who was thinking, I'm going to live in the house 4 or 5 years, you might think about going conventional because your loan to value would be lower. Your loan to value would be in a better spot with a conventional loan than rolling that in.
But if you're somebody who's going to live in the home for the what the average is now, which is closer to 13 years now.
Isn't how long it's extended?
It's gone up so much. Yeah, and for many reasons. But yeah, the average stays about 13 years now. So,
and again, one of the things that's great about the lower monthly MIP, a lot of people who wouldn't think about FHA loans may, because the higher sales prices and the higher interest rates that we're dealing with right now make it tougher to qualify for a conventional loan, but you may be able to qualify for an FHA loan. In the past, anybody who had a 740 score or higher, I almost exclusively looked at conventional loans, especially if they were a first-time home buyer. But many who have 740, even 760 scores, I might look at an FHA loan and see if the monthly payment's different, especially if that's what's important to you, especially if the house you want, you need that higher debt-to-income ratio to qualify.
Yeah.
When it comes, now this is where I'm going to rely, I don't know if this is a con, but potentially a con, and hopefully it'll change. From a realtor standpoint, specifically a listing agent standpoint, when you see an offer that has an FHA
or any government
loan or a VA, because there's some more things involved than a conventional loan, do you have any hesitation?
It really depends on a number of factors, but the condition of the home can be an issue with an FHA or other government-backed loan. And if the house is not, I'll call it FHA ready, meaning no chipping paint, handrails where there are more than 3 steps, things like that. You know, the health and safety issues that typically get called out by an FHA or government appraiser that need to be repaired or fixed before the new homeowner can purchase the home. If the house is in great shape, it really doesn't matter.
Right.
If the house has issues, it's something to consider. And because a conventional loan very often will call out fewer of those issues. Doesn't mean they won't call out any. I think very often there's this misconception that conventional loan will let anything get through. That's not true.
No,
that's not true.
If you have a breaker box that doesn't have a cover on it, that's going to be called out.
Absolutely.
Anything that's safety or...
Yep, things still get called out on conventional loans. But they are, in general, a little less restrictive than the government-backed loans. So it's a consideration that a seller makes. But by and large, if your home's in good shape, it's really almost irrelevant.
So, I mean, moving forward, given this change, we both speculated and wondered if listing agents should prepare their sellers to have their house FHA ready, because there may be buyers out there that,
even though they qualify for both, it's more advantageous to go FHA.
Monthly payments lower. Another advantage of an FHA loan, and it also applies to all government loans because there are streamlined refinances with them.
Yeah.
It's a very easy loan to refinance. If rates were to drop for an FHA home buyer 6 months, a year and a half down the road, you can refinance without an appraisal, irrespective of the property doesn't have to go up so much in value to qualify or pay down the loan.
Right.
So it's a great product. Listing agents shouldn't be afraid to accept an offer from it. There may be very valid reasons for a buyer to be using
It's
that.
certainly worth having the conversation.
100%.
Yeah.
I like I said, I sat down with borrowers the other day, and there was a small difference. It was slightly better. These were 780 borrowers, and the monthly payment. Now, having said that, the reason FHA was better is because they made too much income to do the home ready, home possible, or
Right.
they were above 100% of the area median income.
Yeah.
For a conventional loan.
Yeah.
So
All right. So we'll be back in just a minute with the second half of The Scoop.
Try it.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long and Foster.
I'm ready. I'm waiting for this next adjective to come out. What are you going to lay on me now?
And sitting across from me
Is the effervescent?
is the resplendent
I might be resplendent. That's fair.
Michael Becker.
Thanks, Brad. Michael Becker, Sierra Pacific Mortgage. Brad, we've been talking about low down payment loans geared towards first-time home buyers.
Yep.
Many others can still qualify for it. Talked about the pros and cons of each. Tried to highlight everything. Hopefully we don't forget anything.
I think we did. We covered quite a bit.
Well, one thing so there's additional ways to get in the house in addition to having your own money for the down payment
Right.
and to cover closing costs.
Getting a little seller help.
So the second part of the scoop, I thought we'd talk about two things.
Yeah.
One is seller help, or what we call it in the mortgage industry, interested party contributions.
Yes. Yeah.
Seller helps can go to cover closing costs. They cannot cover down payments in the instances when down payments are required.
Right.
However, we do have DPA loans available, down payment assistant loans, a Maryland bond program that we're going to talk about,
Some grants.
some grants that can help people with less than a minimum down payment get into the home.
Yeah.
So let's cover those in detail. First, let's go over the first four loans by type that we talked about. Again, USDA, VA, conventional loans with 3% down, and the FHA loan with 3.5% down.
Right.
USDA allows 6% of the sales price
For seller help.
for seller help. Is that enough to cover all the closing costs?
Yeah, in most instances.
The median home outside of Baltimore City, and I say Baltimore City because property taxes and the transfer and recordation taxes there are a little bit higher.
Yeah. Of course, in USDA, you're not worried about Baltimore City, but
True that. True that. You're right.
Yeah.
100% right. So let's nix that. 6% would cover. I usually tell people in the Baltimore area, 4%
yeah.
of the sales price is probably a good, safe, round number to come up with.
The lower the purchase price, the higher the percentage.
Correct.
Because of
150
because of the fixed costs.
So what Brad's saying is many of the closing costs are fixed. They're not based on the loan amount. A small percentage of them are based on the loan amount. So when you borrow $150,000, your closing costs might be 5 or 6% of the sales price.
Right.
If you're borrowing $750,000,
Much lower percentage.
it might only be 3%
Sure.
of the sales price are your closing costs. But 6% generally will cover everything.
Almost everything.
Let me ask you as a
Pretty
realtor, it's not often you see that.
Especially not now.
Now it's harder and harder to get the seller to contribute towards closing.
Right. When you get to more of a balanced market, you can often get seller help. And there were times when we were getting 3, 4, 5%. Sometimes you get 6%, but that's
I would say
it's
in
the
the
extreme exception right now.
my best guess would be in a balanced market, the median seller or interested party contribution, seller help or interested party contribution was about 3%.
Sure.
Seemed to be something that happened more frequently.
Yeah.
I mean, you remember the days when we did USDA loans and VA loans? Those are 0% down payment loans where we got enough seller help to cover all the closing costs. I've done VA loans where the borrower, not only did they not have to come to the closing table with cash, they got a check because they got part of their earnest money deposit refunded to them at closing.
Right.
Oh, I miss those days.
Yeah. That was nice.
Don't know if they'll come back. But
there's another thing that I want to mention about the down payments. If you're negotiating the seller, not down payments, but the seller concessions, when you're negotiating them up front, always keep in mind that based on the condition of the home, if you're going to ask for any repairs at the inspections,
don't use it all up.
You can't exceed that total seller contribution. So if you've negotiated 6% up front, you're out of luck. You can't get any more seller help. Repairs will have to be made.
I've seen it happen with rookie realtors where I get a contract on a conventional. Well, we're going to get to that.
Yep.
Get a contract on a conventional loan where they're at the maximum amount. Then inspection comes by. There are things that have to be repaired, but the sellers don't want to repair them and offer seller concessions. Well, we're already at the cap, so there's not much you can do.
Yeah. Yep, absolutely. All right, so let's move on to VA.
VA has got pretty much you can get all your closing costs taken care of, but they have a very interesting way of wording. They don't give you just a percentage of the sales price.
Okay.
Interested party contributions, i.e. seller help, is kind of what we most say. The seller can pay 100% of reasonable discount points and the borrower's non-recurring closing costs. Reasonable discount points are you cannot pay 5 points to get the rate down. 1 to 2 points. What normally happens in a transaction is with reasonable discount points. And I would say it's usually between 1 and 2 points.
Sure.
Meaning you can get a much lower rate if discount points are paid. The seller can also provide an additional amount not to exceed 4% of the established reasonable value, i.e. the value of the home, the sales price or the appraised value,
right,
to assist the borrower in the payment of buy down points, prepaid expenses. That's money that goes into your escrow account for taxes and insurance moving forward, and the funding fee. Yeah. So we mentioned a funding fee. If you're somebody who's not exempt of the funding fee for a VA loan, which can be anywhere from 3.3% to 1.4%, that's right, the high and low, depending upon first use or subsequent use in the down payment. You can have the seller pay the funding fee and not have it rolled in the loan.
Yeah.
I will let everybody know that if that funding fee is being paid, it must be paid in total. You can't pay for a portion, have the seller pay for a portion. So if your funding fee is 2.3% and you're getting 3% from the seller, then you only have 0.7% of the sales price to cover other closing costs.
Right.
In that instance, I'd probably recommend the borrower have the funding fee rolled into the loan and use it to cover the other closing costs.
Sure. Less out of pocket.
Less out of pocket expenses. Right. You get it. See how because when I say things to you,
sure,
you grasp it pretty quick. Next one, conventional loans. You know this.
Yes.
All right. What's the limit on interested party contributions, or what we call seller help?
When you are putting the smaller down payments down, and it goes up to 10%.
Right.
But
3, 5,
5 or 10%. Yeah.
Or 9.9, because once it gets to 10,
9.9 is 3%. Maximum seller concession.
3% of the sales price.
Correct. Yes.
If you put 10% to 24.99%.
Then it moves up to 6%. And if you go above 20%, you can get up to 9%.
Above 25%.
25%. Yes, that's right. Thank you.
You're welcome. But 9%. Can you imagine getting 9% seller help?
I cannot right now.
If you could conceivably cover your closing costs and have 4 or 5 points to buy down the rate.
Wouldn't that be amazing?
One thing that people forget, again, it's harder to happen, but it's worth remembering. Did you know that seller paid discount points? First of all, discount points are tax deductible in the year that they are made.
Yeah.
If the seller pays for those discount points, who gets the tax deduction? The buyer.
Which is just crazy, but
no, it's a nice little tax benefit.
It is a nice tax benefit.
Well, the seller's going to get a benefit because it's going to reduce, if they have a capital gain to talk
It'll reduce their capital gain.
Because it's a cost to sell the home.
Yeah.
So that's actually basically what discount points are: prepaid interest. You're paying money up front to have a lower interest rate over the life of the loan. A real quick discussion of discount points right now. I'm not a fan of them normally. The only exception is when rates are at all-time lows, then it probably does make sense to pay it because it's a sunk cost.
Yeah.
I'd rather you pay off your other closing costs before buying discount, having the seller pay discount points, because given where rates are now in their interest rate cycle, there's a likelihood you'll refinance. And if you paid those discount points, that's a sunk cost that you'll never get back.
Right.
Now, however, when rates were in the low threes or high twos on 30-year fixes, it may have made sense to pay a point to get an even lower rate because you and I both know you're going to have that loan for a long time. All right. Now, FHA, 3.5% down, we're going in order.
Yep.
What are they allowing?
Up to 6%.
6%. So 6% seems to be a common number outside of conventional loans with a low down payment.
Right.
So, again, folks, these are things to help cover your closing costs. You still, if you have a loan that has a down payment required, or what we call a borrower minimum contribution,
still have to come up with that.
Correct. Now, those down payments, didn't talk about that much in the thing, but usually down payments come from your savings. But they can, in both instances where we have a 3% and a 3.5% down in the conventional loans and the FHA loan, both of those down payments can be gifted to you from a blood relative.
Right. Yeah, sure.
You have to be related by blood or marriage.
Yeah.
Meaning, in an FHA case, you can get a gift from someone with a close established relationship. It's very hard to document, but somebody who is a lifelong friend, or if you were raised by a man who your mother never married.
Right. Sure.
If you could establish that relationship, that person could also conceivably make the gift. All right. So we've covered closing costs and closing cost help. If people are first-time home buyers, right, and they do not have deep pockets, and they do not have family members with deep pockets to make a gift,
right,
but they want to buy a house, there are programs out there from Maryland, because we're in Maryland, that help.
Can help with that down payment assistance.
DPA, that's what it stands for. What is the program called? We call it MMP. What is that?
Maryland Mortgage Program.
Correct.
Yep.
And they have programs out there that help with down payments. A first-time advantage, which actually is no down payment assistance, which we can do, right, but it may actually have a lower rate than what the market has.
Yeah.
Then there's the 3% DPA, down payment assistant loan. Then there's a 4% down payment assistant loan and a 5% down payment assistant loan. We also have a Flex 6,000 down payment assistant loan, which
sounds like a car. Or
it's
exercise. It's a fitness machine. The Flex 6,000.
Is it like a Thigh Master?
Yeah.
Anyway, and then we have a Flex with no down payment. We have one with 6,000. That's a specific dollar amount, and then one with a 3%. Those Flex programs is a reason for using the Flex. And what does that allow you to add to on top of the down payment assistance? Those grant programs that your employer and other people, you can stack them, is what we kind of talked about.
Stackable grants.
Stackable grants, right.
Yeah.
So one thing to remember, though, the higher the down payment assistance you get, the higher the mortgage rate's going to be on that. I'm going to pull them up. I'm pulling them up right now just so you can see based on
here.
See, that I can see and that you can hear.
Yeah.
Thank you for correcting my misspeaking. So, for example, if you wanted the 3% down payment loan or the 6,000 down payment assistance loan, the Flex loan, I'm sorry, the 6,000 or the 3%, it's 6.875. If you go to 4%, the rate goes to 7%. Now, these are on conventional loans.
Right.
And then if you go to 5%, it's 7.25. So as you get more...
As you get more help, it goes up.
Nothing's free in this world,
sure,
essentially. But when you're buying a house, it's most important. If you have very little funds to get into, you get what you need. So,
well, you say nothing's free, but some of these grants,
some of the grants are free. They don't have to be paid back. You're right about
beautiful things.
That. But there are restrictions in that you have to live. You have to live near your work. Well, we'll get into them in a second. I don't want to get ahead of it. Basically, what I wanted to say is that there are Maryland mortgage programs, down payment assistant loans. Now, it's important to state that these are loans. The way they work is they are recorded as a second lien against the property. You have your first mortgage that goes to whatever the loan. Well, like if it's conventional, you can do 3% down. If it's FHA, it's 3.5%. If you do, you can do VA or USDA loans with these. They would be 0% down. Real quick, let me run through the 3% on a government loan. 6.5%, 4% is 6.625, and with 5% down at 6.875.
Okay.
All of them are above what you
Slightly
can get
higher than what you can get.
you get in the open market.
Yeah.
But remember, you're getting it. Again, you have a first lien product. These down payment assistance would be loans. They're 0% interest, meaning you never pay interest and you never have to make a payment on it. However, when you sell the home and or refinance,
They have to be paid back.
they have to be paid back. Right. But the idea is it helps you get into the home. If home appreciation takes off again, or it sticks to historic standards over time, you'll recoup more. The appreciation of the house will more than offset it, and you'll be able to pay those loans off. If you're looking at doing a MMP loan to buy a house and sell it in 3 years, might not be the wisest move.
Right.
Might be tough to cover paying off the loan and that down payment assistant loan. Now, as I mentioned, those flex programs for first-time home buyers do allow you to stack some grants on it, and you had a little bit of grant information you wanted to talk about.
Yeah, there's a number of different grants available. So Live Near Your Work is one that is...
I like that one.
It's a great program. So Baltimore City grant program, your employer and the city both contribute to that grant, but you can get $2,000 to $5,000 grant, meaning it's free money.
You know who the most people I've helped with that? Because it's got to be close to your work.
Yeah.
Tons of people at Hopkins.
Nurses
take advantage of that.
Anybody who works at Hopkins. It doesn't. You don't have to be a healthcare professional.
Right.
You could be in any department at Hopkins, and it's...
Well, and Hopkins has that program as the employer. Not every employer has it.
Correct.
So you can get the city portion of it, but your employer
When
might
there's a
have it.
list of employees that qualify for that. But here's the other thing about Live Near Your Work. If your employer doesn't currently qualify, it's not awfully difficult to get them to qualify if they're willing to do it.
Right.
Yeah. So that can be a very interesting grant, and that, like I said, that's grant money. That means it's free. You don't pay anything back. So
you have the trolley tour.
Well, yeah, absolutely. So
I'm sorry,
the trolley tour. No.
You have all those notes. I just want to
I have many notes. Yeah, Buying into Baltimore is a program run by Live Baltimore, and we often call them the trolley tours. There's actually one coming up on May 13th. I don't know if it's full yet or not. They do max out, but they tend to have quite a few people who go through these trolley tours. You can it's a $5,000 forgivable loan. It's based on a lottery system, but you can use it citywide. It's not limited to first-time home buyers, though. Right. And by the way, for some of these programs, first-time home buyer is a little bit of a different qualification than it is for taxes and for other things. So we're not going to get into that right now. But first-time home buyer in this case is you haven't been on a deed within the past 3 years.
Right. It's different than for tax purposes, recordation transfer taxes. If you've ever owned a home in Maryland, you're deemed not being a first-time home buyer. But for this program, it's 3 years.
Yes, but they give out 20 grants a year. You have to apply for the lottery within 10 business days after the event, which means you'll have had to find a home and write the offer and then apply for the grant. But that's a great way of getting an extra $5,000 for the down payment. All right. There are a couple of other ones. If you're interested in buying a property for maybe development, there's the vacants to value. That one is it's a $10,000 forgivable loan. It's designed to spur development. The property has to have been tagged as vacant, registered as a vacant property in Baltimore City for a period of 1 year. But it can convey to a first-time home buyer buying the property. So if you go and invest and you buy this property and you make that and you make those changes and update it, you can actually have that forgivable loan applied to the first-time home buyer who's buying it after the renovations are made too.
Right.
So it's worth checking to see if the property was vacant before you purchase that home. Okay, there are some other ones. There's a Baltimore City Employer Incentive Program. That's a $5,000 forgivable loan. You have to be a city or quasi-city employee for at least 6 months to qualify for that. There's, let's see, we didn't get into the specific ones with MMP, but the house keys.
Oh, house keys for employees.
Yeah, the house keys for
So
employees.
those are good ones because often they can be grants, never have to be paid back.
Yeah.
And they can be stackable, but they don't have to be paid. They don't have to be used with the Maryland Mortgage Program.
Yeah. So some interesting possibilities.
I wanted to highlight all those programs that were out there.
Yeah.
Down payment. You have closing cost help, and then you have down payment assistance. Sometimes, if you're fortunate enough to get a down payment assistant loan and a little seller help, you can potentially get into a home for no money out of pocket. It's going to be tougher these times. One thing to realize with seller contributions, the limits are based on the program, and income limits and stuff like that apply. Yeah. Same thing with down payment assistance. There are a few considerations to make. First of all, to do any of the loan programs that I've mentioned with Maryland Mortgage Program, you need a minimum score of 640. Mm-hmm. And you are also capped at a 45% debt-to-income ratio. That's lower. Remember when I talked about the USDA? That's just a little higher than the USDA and probably lower than you might be able to get otherwise with an FHA or a VA loan. Also a conventional loan if you have a higher credit score. If you have a 680 credit score, you can go to 50%, so that does help. Also worth remembering is that there are income limits, and it's based on a number of those in the household, and it is also household income, like I mentioned earlier in the program, not qualifying. Anybody who lives in the house, we have to consider their income. In Baltimore County, in a non-targeted area, there are targeted areas where they want to encourage people to live, so the income limits are higher.
Right.
Baltimore, let's just do the Baltimore area. I'll say Baltimore County because it's pretty similar in the Baltimore area. A 1 or 2 person housing, the income limit is $117,500. 3 or more, it's $135,000, $125,000. Okay. These are non-targeted areas. If you choose a targeted area where they're encouraging home ownership, that income level goes up to $141,000 for a 1 or 2 person home, and up to $164,500 in a 3 or more person home. Yeah. So we have debt to income ratio, credit score requirements, and income limits. One last thing that has to be said with a Maryland Mortgage Program, you cannot have more than 20% of the purchase price of the home in assets. A gift of equity, if you're buying a house from somebody using this program, that can be considered in your assets. But it kind of makes sense when you think about it, Brad. Somebody with a lot of assets and high income probably
doesn't really need to be pursuing
these grant programs are for first-time home buyers who are low
really
to moderate income,
people
who are
really
trying to become homeowners.
Yes.
So don't come to me with $100,000 in assets and a $200,000 job and expect to get a grant.
Yeah. Sure.
Make sense?
Absolutely.
It only seems fair, right?
Yeah, absolutely. Oh, and I'll add one more thing to this. If you have an interest in pursuing one of the CDA loans, MMP loans, one thing to consider is the amount of time necessary to close that loan.
And that can affect the ability to get a contract accepted.
It can.
That is worth mentioning.
Yeah. So
let's talk about that.
Very often in a competitive market, and it's not always the case, but very often a quicker close may be desirable. If that's the case, you may have a problem competing if you're trying to purchase with a CDA or MMP loan because there's third-party approval required for those programs. Michael and his team could wrap things up very quickly on their side, but it's still got to go to the third parties for approval, and that will often take in excess of another probably 2 weeks or so.
Yeah, sounds right.
It can add time. So the point is,
you're not going to get a 30-day.
You're not going to get a 30-day close.
We underwrite the loan just like any other loan. Once we're finished with underwriting and issue a clear to close, our underwriter will ship this loan package to the Maryland Mortgage Program and their underwriters, and they will review it. They're just looking for accuracy. They're not going to re-underwrite income and everything. Yep. They're going to look for accuracy. It takes a little bit of time. Yep. And once they do that, then they approve it and it can close. It's also worth mentioning that loan cannot be, that rates that we mentioned earlier, they are changed on a daily basis. Unfortunately, you cannot lock your rate in at origination or at a contract acceptance or ratified contract date. It has to be, once it's approved by or it's sent to MMP for their underwriters, at that point you can lock it.
In periods of extreme volatility, there can be a little extra risk
You should definitely, I think that's something you would consider if we're in a period of, and it's hard to tell when we're going to have a period of rising interest rates, because from January to early February, it looked like rates were dropping and going to continue to drop. Then we saw a spike in rates. So somebody who kind of went under contract in early February, planning on to use this program, by the time they got ready to close the loan, the rate may have been higher. And my concern is, what if their debt-to-income ratio went up and you didn't qualify?
Yeah.
So maybe leave yourself a little bit of wiggle room when it comes to that debt-to-income ratio.
Yeah.
Again,
great advice.
It's going to be, I mean, when you're off, if you're using this program to submit an offer, I don't want to step on your toes, but let me ask you this question. If you were submitting this offer in a competitive situation and you needed more time to close and they knew that you were going to do this, and somebody else has an offer that's not going to require this long or the use of this program, chances of getting the contract accepted.
And there are some times when an intangible may mean more to a seller than
than the dollars, right?
Than the dollars involved, or
they may have a special place in their heart for somebody who wants to live in the area.
And you know, we have to be careful about fair housing issues. You know, that we're not asking you. We don't want you writing letters or any of that kind of stuff. That's a no-no. But there may be certain intangibles, flexibility on closing dates, or other things that you could say. Oh, we don't need you to remove that sofa, or we don't need you to do this or that. And if the seller finds that appealing, maybe you have a little bit more of an angle to play there than just the strict dollars and cents of it. So I'm not going to say it's never going to happen, but it's more of an uphill battle to get a CDA or MMP loan accepted in a very competitive market.
The purpose of the scoop this week, folks, was to give you ideas of how to buy a home with limited resources or small down payments.
Yeah.
It is a very challenging market out there. It's worth exploring your options just so you know where you're going. The homes that aren't HGTV ready, turnkey, however you may put it.
Right. Still fine, maybe fine from a safety perspective, but is not quite as desirable. But that could be a great avenue for somebody who needs some down payment assistance or seller help to get into a home that they may otherwise not be able to afford, and get and compete on those.
Correct.
Because there's going to be fewer interested parties.
It sure seems like that. The homes that, if you look at a house and you're looking at the pictures on Zillow, Realtor.com, Trulia, wherever, and you'll see the interior pictures that it looks just gorgeous. They always seem to go in 4 or 5 days.
They tend to go pretty quickly if they're priced right.
Anyway, information for you folks.
Yep.
These programs are not going away. They're going to be available for you now and in the future. But if you ever wanted to become a homeowner, I think the best first step is to inquire, to figure it out. We gave you a little bit of knowledge here as to programs that are out there for you, but you have to take the next step and contact us in order for us to figure out the best path forward. There's nothing more satisfying for Brad or myself than helping a first-time home buyer figure out the way to become a first-time homeowner, especially if they never thought it would be possible for them.
Yeah, absolutely.
All right.
Well,
that
thank
wraps
you,
up the scoop.
Fantastic. When we come back, the unreal and the spotlight in just a bit.
Try.
And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, and I'm talking quicker because we've had a very long episode. And Michael...
You know what? Then forego the adjective that you're going to call me. Just say it's Michael Becker of Sierra Pacific Mortgage. And we're on the unreal. We have something that I thought was kind of unreal when you mentioned it to me. Why don't you read the headline or explain what we're talking about?
Right, so here's the headline. It's on weeklyrealestatenews.com, WREnews.com. The headline is, Wild Swings in Interest Rates Are Making Sellers Hesitate to List Their Homes. This was on March 21st. It says, according to Zillow's latest market report, mortgage rates, both their high levels and wild swings, are making life difficult for buyers and sellers. Relatively high rates have reduced new listings to record lows. We've talked about that. We don't have the inventory. Leaving buyers with limited options. Any dips in mortgage rates stimulate demand and stiffen competition, but they have been short-lived. Goes on to say we know there are a lot of motivated buyers for looking for homes. When we see, this is a quote, by the way, from Skylar Olson, Zillow's chief economist. When we see mortgage rates fall, sales pick up, but buyers are disappointed in their options. Homeowners aren't giving up their current house and low monthly payments to join a tight, expensive market. Meanwhile, volatility in the economy makes planning extremely difficult. Michael, you were showing me a 6-month view.
Yeah, this was of the 10-year treasury, which tends to follow where mortgage rates are. And over the last 6 months, we've seen 3 spikes and 2 valleys, or 3 peaks and 2 valleys.
And pretty extreme swings.
Huge differences. It can be as much as in early fall, we were probably in the high 5s, went all the way up to 7.37. That's a 1.5% increase. Then they dropped into December, most of the fall into early December, probably close to low 6s, maybe 1.25 point drop.
Yeah.
Then they spiked back up to over 7% again, only to drop now back down into we're 6.25, 6.5 range right now. 6.38 is the average at Mortgage News Daily for the best borrowers out there. Remember that, folks. Yeah. But those spikes of 1.5%, 3 spikes of 1.25 to 1.5% over a 6-month period, that's quite extreme. It takes often the decision to sell a house is not something that happens instantly, and it takes a little while, as our previous shows highlighted, to prepare a home for sale.
Yeah.
So if you thought about rates are dropping on, maybe it's time to sell the house. When we buy the next house, I can get a little bit better rate. Let's move. And the next thing you know, just as you're getting ready to sell, you spike it. So it kind of freaks you out and pulls back.
Right. So we're getting a lot of reluctance from sellers because of this. That's the message. That's the point. The takeaway from this. It's a tough time to plan for some of those kinds of things. And so that's creating some of this seller reluctance, hence the lower inventory, hence why some of the prices are staying where they are.
To sellers, I have something for them to look at and pay attention to.
Yeah.
The Federal Reserve, it seems like the Federal Reserve's path to further interest rate hikes may have slowed down. This bank crisis, semi-bank crisis, bank failures, whatever you want to call it, is probably going to lead to tighter lending, which will help slow the economy, which will help inflation. Once inflation starts coming down and we don't have a pickup in it, we will probably see lower fixed rates. To that point, the Mortgage Bankers Association,
their predictions,
predicts mortgage rates. They updated the most recent one. Of course, it's not up. It's green. I had it up. It's not there. But anyway, they predicted I want to say at the end of the first quarter, 6.4% is the average 30-year fix.
Yeah.
End of the second quarter, 6.1%. End of the third quarter, 5.7%, and in the fourth quarter, 5.3%. Now, they could be totally wrong about that.
Crystal ball, tough to say. Right.
But they do have interest rates declining. I get a sense the Fed has been hiking rates. Their first hike was just a little over a year ago. It takes a while. Those rate hikes
it takes a while for that to have
just
effect.
Hitting the economy now.
Yeah.
And they're keeping them up there, so I do think they're going to finally have an effect. The big question mark also is employment. If unemployment starts increasing, jobless claims has remained surprisingly low for a long time.
Right.
If that starts upticking, then you'll know that lower rates are in the future. But we'd have to have some kind of inflationary surprise for rates to start moving up again one more time, especially after the stress. The higher rates have caused the banks and the Fed being fully aware of it.
Yeah.
They may talk less hawkish and more dovish. So don't be afraid. If where rates are right now, it makes sense to list your house and sell it. You're in a great position as a seller.
Very strong position.
And I feel pretty confident that rates aren't going to go sky high from here. They're not. I'm going to say it. I'm going to go out on a limb. We're not going to break 7% again during this cycle.
Okay.
That's not that much of a risk. I mean, I'm not going out on a limb too much to say that.
Yeah.
But if I'm wrong, beat me up. Let me know.
Yeah.
Hopefully you're not. Call me.
Hopefully you're not wrong. All right. Well, Michael, that's the Unreal. Thank you. We're going to shift into the spotlight now. And this week in the spotlight, we have a reincarnation.
Oh, my gosh.
Yeah.
One of the first jobs I had there, me and my friends had there. I grew up out in Baldwin, Maryland.
Right.
So I know many of us worked in the kitchen with Joseph. I don't know if you remember the chef of Pierce's Plantation.
Yeah.
Old player back in the day.
Back in the day.
Was Joseph, and then he opened out in Upper Crossroads,
Right.
Falston area, opened a restaurant called Joseph's, which
Right.
I also worked at for, I think, 3 nights.
Well, it was one of the in spots, right? When we were in high school back in the day, it was
Beautiful place overlooking Loch Raven.
Yeah. So
What is
Pierce's on Delaney Valley Road in Phoenix.
Is that what it's called? Pierce's.
It's called Pierce's.
Not Pierce's.
Not Pierce's Plantation anymore.
Gotcha.
The address, 12460 Delaney Valley Road in Phoenix, 21131. It's been through a few incarnations over the course of the years. The latest being since 2019. It's an Indian fine dining establishment.
Indian, really?
Indian food, great Indian food. Kier and Binda Singh are the owners. When the weather warms up and they roll up the garage doors, they have this beautiful outdoor dining area, has fountains and greenery, and I'll tell you that it's just the ambiance there is phenomenal. But their food, do you like Indian food?
Some.
I'm a fan. Sometimes it doesn't like me, but
I can see why. Yeah.
Right, but I am a fan. Even their appetizers are standouts, right? They have this one that's called Gobinda, roasted
Gobinda.
Gobinda, roasted cauliflower, lime, chili, tamarind, toasted sesame. It's so good. They also have these meat samosas, just flaky. Man, just so good. All right.
No, keep
and
talking.
then their entrees are amazing too. Just tons. I mean, that's the thing about Indian food, right? So many good, rich, exciting flavors. So if you're a fan of Indian food, and maybe if you're not, if you want, try it out. If you haven't been,
it says here
give
it's
them
called
a try.
the Grill at
The Grill at Pierce's.
That's right. That's the name, right?
Okay, fair enough.
I could be wrong.
So they are on Instagram at Pierce's _, and it's PEERCES _ on Instagram, or at Pierces.com, PEERCES.com, or you can call them 410-252-6150. But folks, amazing food. Pierce's, give them a shot. I think you won't be disappointed. So Michael.
Yes, sir.
Episode 11.
In the books.
Very good.
Hope we give it. We're really trying to give you good information, folks.
Yeah.
I hope it's helping.
Yeah, working on it.
If you listen and you have any comments, constructive criticism, we welcome it.
Yeah, absolutely. Check us out on berealpod.com. You can listen on the site, but you can also submit those comments or feedbacks right there on the site. Let us know, how are we doing, or what do you want us to talk about? You can also get us on all the major podcast platforms: Apple Podcasts, Google Podcasts, Audio, Spotify, iHeartRadio, Stitcher, Podbean, etc. Really appreciate you listening, folks.
Well, if they do want to comment and not do it on the website,
or
they had a question on any of the information in the show,
well, they can reach out to you or to me.
Well, how do they get a hold of you?
So if they want to, let me just say this. If they want to reach out to both of us, we have an email for the podcast.
I love that.
Hello.
Then we would know where it came from.
That's right. Hello at berealpod.com.
Hello at bereal.com.
That's right.
berealpod.com.
Yes.
P-O-D.
Yeah.
BeRealPod.
Yeah. But Michael, if they want to get you directly to talk about the mortgage scene.
Cell phone's the best way to reach me. You can text me or give me a call, 443-310-0012. If you want to email me, you can email me at michael.becker@spmc.com.
And so if you want to text me or call me, my cell is 410-375-7550. Email at brad@homesbyvesta.com. So, Michael.
Yes, sir.
Next week, we got a couple of ideas. We're going to flesh it out. We'll get it nailed down.
Whatever it is, it'll be incredibly important, thorough,
and timely
information for you.
Yes. We have a whole year planned out. It's just, do we want to switch something?
Yeah, we try to do it in time, like you did your home cleaning. It was perfect for the podcast hit the first day of spring.
Yeah.
We're getting into the spring buying season. I thought going over these low down payment loans, because it does seem to be a challenge for buyers coming up with down payment and closing costs, given the restrictive supply. So hopefully this will help, and hopefully people will reach out to us with more questions.
Absolutely. Well, Michael, thank you again.
Thank you.
Absolutely. And folks, we appreciate you listening. We'll see you again in the next episode of Be Real,
the Maryland Real Estate Podcast.
Take care, folks.
Try it.